Some people say choose a HELOC over reverse mortgage for the baby boomers. And is that a blanket answer given that the HELOC is generally cheaper? Well, in this video, we'll talk about where the HELOC may not be cheaper long term and what that fine print is compared to reverse mortgage.
Hold up.
The two biggest caveats on a HELOC or a home equity line of credit are: one, you have to make mandatory payments every month versus reverse mortgage, you do not. And also, again, although the HELOC is cheaper, there are stricter provisions on when they can call the loan, especially if a spouse dies. Let's get into it. The basics on a HELOC are whatever the prime rate of Canada is at the moment. Generally, you add about 0.5. In this market in 2026, it's about 4.5%. So we'll call it 5% interest rate on a HELOC. Typically, a reverse mortgage is 2% higher. There's a clear arbitrage on interest rate. So your gut's going to say a HELOC makes a lot more sense. And it can. It truly can. But if you're looking at it at face value, this is where it may not make sense. So let's say you get a HELOC and you qualify for a HELOC only if you make enough income. So let's say there's a couple and with their CPP, OAS, maybe some rental income, maybe a little bit of a part-time job, they qualify for, let's say, $400,000. So they have $400,000 they can qualify for with a conventional HELOC, 5%. Versus the reverse mortgage, it's going to be 7%. So why not go for a cheaper rate? So you do that. Now, where are the parts that can come back to haunt you? Well, step one, on a $400K mortgage at around 5%, the interest-only payments you must pay every single month is about $1,666. So that's a liability. And if you can't pay that because further in the future, you stop working, you have less pension income, more expenses. Well, now you've got a stressor. Is that something that you can handle? Only you can answer that. But if you don't pay your monthly payment, you're in default. And much like a mortgage, you may have to sell your house. Not fun. The other way that this can be a detriment is with a HELOC, like a mortgage, if you want to top it up for more, or the bank finds out one of the spouses passes away, so they have to requalify you. If you don't requalify for the loan, they're going to have to make you pay the loan. In any specific story, when you take a HELOC chunk, which could be also a reverse mortgage chunk, it's usually the gift to your kids as a gift for a condo, pay off some debt, or to use for everyday life. So in many cases, the couple may not be able to pay back the loan. So if there's just one remaining spouse that survives and is still alive, they now have the loan called on them and they have to sell the house. And then it's a lot of pressure. And what if the market's not very good? Where do they go after that? So like any mortgage, you have to be very conscious that a HELOC is like a mortgage and it's cheaper, but it has its downsides, right? And on that case, maybe you just get a mortgage actually instead of a HELOC. Well, typically the mortgage will be a bit cheaper than the HELOC, but also there'll be more monthly payments because it's principal and interest. So same story there. Once the spouse passes away, they're going to call the loan, right? So just do the math on that, right? And make sure it makes sense for you, okay? So unlike a HELOC with a reverse mortgage, they will never call the loan unless you break the rules and you start renting it out. You have to be there at least 6 months, so it must be a principal residence. If you rent it out or it gets into really bad condition or there's a lien on your property, those are always where they would call the loan. But if you're just living there, they cannot call it until, let's go back to the story, the last spouse passes away, and that's when they sell the house. If you don't want the pressure of monthly payments, remember reverse mortgages are payment optional every month. The bank is budgeted to collect their interest and of course their initial principal once both spouses pass away and or the house is sold. So there's a lot less stress in monthly payments, and if one spouse passes away, as long as the other one is still living in the property, the loan will not be called by the lender. And that could be a sigh of relief for a lot of people. So that really quickly are a couple things to think about with HELOC versus a reverse mortgage in the case of finding out how do you balance out a cheaper HELOC rate with less pressure on the reverse mortgage side, albeit it being a little more expensive. To conclude, when does a HELOC make the most sense? Number one, both spouses are a little bit younger, maybe early to mid 50s, maybe in the 60s, still working, two incomes, can very comfortably pay for the monthly interest-only payment needed on the HELOC. That's no problem at all. And they have a cushion financially. They might have savings where they can pay off the HELOC. Ideally within a few years, that is when it is the safest way to do it. And again, you'll win on a cheaper rate and you can keep drawing on the HELOC over time. Now, if you are retiring quickly and CPP and your other income sources are not really covering or getting close to the interest-only payment, in the case of the video, it was about $1,666. Well, that becomes a bit more stressful. If you've got support from your kids or you've got a renter, again, it's a cash flow thing. You have to pay interest only every month. And if that's stressful or becomes unfeasible, then you have to be very much open to the possibility of having to sell a house at a certain point. So, pros and cons on profit versus practicality, only you can answer that. Of course, if you want to run a scenario of HELOC versus reverse mortgage over a handful of years to see how much equity you'll have left to pass on to your kids and or what's actually feasible from a cash flow perspective and running different scenarios, come talk to me. Happy to do it. Thank you for your attention. And most importantly, stay healthy, be happy. See you at the next video. Bye.